Okay, this is lesson one called Trading with the Trend, and I'm Stratman from pipware.com. One of the biggest problems that traders have initially is determining what the current trend direction is, and we have to make this decision every day, whether we're in a bullish or a bearish market. Now, determining whether we're bullish or bearish comes down to what time frame we're wanting to trade. So if we looked at a lower time frame, like say M1, we can see that price here is making lower highs. If we look at all the swings around here, we've got lower highs occurring, lower high, and this might make a lower high now, and we've got lower lows. So this is a lower low than previously, this is a lower low than previously. So straight away we can see that this is classified as a downtrend. But if we moved up to say the H1 time frame, what's going on here? Well, we do have the same thing: lower lows, lower highs, lower low, lower high, lower low, lower high. So trend is downwards there, but on this side here we've reached the swing at the bottom and we've been moving up. So we've got a higher high than this high, and we've got another higher high, we've got a higher low, and possibly forming another higher low. So during this point in time the trend was considered downwards, and during this point the trend is considered upwards. So this is bearish, this is bullish. Now, to help us make this decision as to whether the trend is bearish or bullish on any particular time frame, the easiest way to do that is to add a moving average. Now, the next question that will be asked is, well, what period moving average do I use, and what period moving average and what other characteristics of the moving average should I have? So as we can see, if I go to the indicators on MetaTrader, I can see that the moving average is considered a trend type of indicator, and that's exactly what we want. So if we open this, we can change the color. We've got to choose the period. We've got to choose what type of moving average we're going to use, and we've got to choose whether we're going to look at the moving average on the close of the candles, the open of the candles, the high, low, and a few other kinds of things. Whoa, gets very confusing. But if we just take the very simplest approach here, and let's just chuck a number at it, say 20, it really in the end doesn't matter what number you use as long as you follow your own rules for a strategy. So for now, let's just chuck 20 in there. We're going to do it a simple one. It's on the closes, and have a look at what is being told to us. Well, clearly as we make lower lows and lower highs, the moving average is showing that. As we make higher highs and higher lows, moving average is showing that as well. Now, if I change this to a much larger moving average, so it's using a greater number of points, like I choose a common one that people might use as a 200, that's going to take 200 points. Well, on this time frame, that's pretty useless. It's telling us the market is flat. So maybe that's a little bit too much. But what it is telling you is that below this moving average, prices, well, if price is below this moving average, we're in a bearish condition. If price is moving away from the other side of the moving average, we're in a bullish situation. So we need to find just a moving average value that is the best for our style of trading. If I take it back to say 60, what's happening? Well, on 60 now it's showing us that on this hourly time frame the market is bearish, yet when we had a 20 moving average it kind of showed that we were bearish and then we're slightly bullish. So you've got to make your own decision on what moving average you're going to rely on, and it really depends on whether you're a swing trader, which means you might hold trades out on the daily time frame and be holding trades for days and looking for a break below a moving average like this. So see how price has been kind of bouncing off this moving average, and it's broken below, and price now started moving away from the moving average, so people took trades short. And down here we're swinging back towards the moving average, so some people might be scaling out of their positions, taking some profits and waiting for a retracement, and because it's still on the low side of the moving average, they're looking to go short again, and they may have entered into some more positions down here short. So one of the rules of using a moving average is typically, first of all, figure out what time frame you're going to. So if we go, that was a swing trader looking at this time frame. If we're an intraday trader, which means we're going to take our trades during the day and exit them during the day, we might want to use that moving average as well and keep on buying whenever price comes down close to the moving average and moves away from the moving average. So if we did that, if that was just our only rule we used, then here we could have entered the market as price confirmed that it was going away, and when we got to a profit point we could have sold. We wait for it to come back down to the moving average, it starts moving away again, we buy again. Here, same thing, buy. This one here, we might have re-entered again. This point here we might have entered, but we're going to be short. Trend is looking like it's changing direction, and if you're used to candle patterns, you'll see that this is forming a head and shoulders here, although I wouldn't take much stock in that because there hasn't really been a huge trend or price action trending upwards till we got to this point. So yes, it looks like a head and shoulders, but it's not as pronounced as one would hope with a longer trend up and then seeing this. So what are we going to do right at the moment? Well, it's tested this moving average, and if it started moving away, came through here, confirmed, closed below a few times, and then started moving down away from that, we might be taking some short trades. But at the moment, because of our moving average, we're looking at taking long trades. Now, that being said, you have to choose which average you're going to use. I quite often use the 20, and if I use the 20 here, you can see it gets a bit messier. What this would do is give me more opportunities to take short trades and to take long trades. It doesn't mean I'm wrong choosing a different moving average, it just means that I'm going to get into more trades. Now, problem is that if you do that, you could end up in this kind of situation, which is not a good one, because you're taking far too many trades, buying and selling. You're now becoming a scalper, and you should be considering going down to lower time frames like the M5 and M1 and having your trades for just a few minutes. So in this case, if we use the M5 and we had our 20 moving average, which is what this is right now, you could have done a quick scalp, buying here and then buying again. Now it's below the moving average, sell, short, come up to the moving average, sell, short. So what I'm trying to get across to you is that depending on your time frame determines what moving average you're going to use, because you chose the time frame because of your style of trading. You're either a scalper or you're a longer term intraday trader, so you might have a trade in for an hour or so. A scalper might have a trade in for a few seconds or a couple of minutes, or you might be an intraday. So you have to be wary of what type of trader you want to be to make a choice on the moving average. But the rules are very simple. The moving average follows the trend, and the moving average, typically you're going to trade away from the moving average. So what I'm saying there is, if I go back down to the M5, over here we won't take a short trade because we're going towards our moving average. But over here we'd take a long trade because we're moving away from our moving average. Likewise here, price came down below our moving average, so we take a trade short below the moving average because it's moving away. Again, we don't take a trade long here towards our moving average because that's not our rule. We always trade away from the moving average. We would only go counter trend, because this is the trend that's been made here, if the distance from here to our moving average is sufficient enough to give us a reasonable amount of profit. Now, you'll notice that the same period applies every time you move to every chart, so it fits quite well. What I like to do is I have a thing called the compass, which is formed from the THV threads coral, and I base it on the 5-minute coral, and I'm just going to place the compass on the thing here, and basically what you see here is the coral on the M5 is a 60 period moving average, and I use that for scalping trades. And if I go up to the M15, what I've done is I've made it so that it doesn't stay as the 60 period moving average. It appears as though it was the coral on the M5. So at the moment it's showing it as a 20 period moving average. If I went out to the M30, I'm going to double my time frame, so I'm going to halve my moving average, so now it's a 10 period. If I go to the H1, it's a 5 period moving average, and it's a smooth moving average. So That's one way. H4, I don't go at H4 because 5 was the number here, and I've got to divide this by 4, and 5 doesn't divide by 4. Anyway, you get the idea. So that's Stratman from Pipware.com giving you an idea of how to trade with the trend.